The uprising in Egypt and its potential to spread through the Arab world was not exactly the start to the year the jittery global markets had hoped for. Nonetheless, investors seem not only to be toughing it out so far, but also hanging on to a degree of optimism. But can it last? I spoke to Morgan Stanley's head of global developed market strategy, Gerard Minack. Well, Gerard, the markets seem to be Teflon coated at the moment. Middle East crisis, sovereign debt problems, inflation starting to be talked about. I mean, should we go through those things one at a time, or is there an overall theme to the market's resilience?
Look, I think it's, particularly in the developed world, it's just all about growth. And that is giving them that Teflon coating. So long as you think the world is normalising, all these other things can be for a while dismissed as embroidery. And it's quite different in Asia, where they are a year or two ahead of us in the West, and they're already concerned about policy tightening. But here in the West, we're still in this sweet spot, outside Australia, of getting better growth news and thinking the ECB, the Fed, the Bank of Japan will not be tightening for at least another 12, 18 months.
So it's sort of a continuation of the QE2 rally, is it? I mean, but it's the global liquidity rally, is that right?
It's the global equivalent, and I mean, we are seeing macro upside surprise in most developed economies now. In fact, the big surprise, we're getting chunky data out of the US, but the real big surprise is out of Europe. And that's why you're seeing year to date.
I saw an OECD leading indicator graph today, and it actually was rolling over quite clearly. I mean, is there any sense in your mind that the recovery will fade this year?
No, I'm actually getting more optimistic. Look, the secret to a sustainable expansion in any economy is getting jobs growth. It's a thing that's been sorely lacking, even in the US, where we've got GDP back to its old prior peak with 7 million fewer workers. But I think all the leading indicators are coming through now that we'll start to see payroll growth accelerate. We'll start to see 200,000 plus jobs a month, and that's going to be when people really go, yep, I believe we've got a year of decent growth. We'll get one last rally up in equities, and then we start to consider all these other things that for now this bullish marketplace can ignore.
Do you think there'll be any sovereign debt problems this year?
Look, it's a real risk. The trouble with trying to say when it will blow up is it's inherently unpredictable. There's a political overlay. And let's not forget that the whole sovereign debt crisis was reawoken last year in Europe when Angela Merkel said, shouldn't some of these buggers take a haircut, which we never thought she'd say. So you've got to think about the politics and the markets themselves. I mean, if the markets say these countries are going to go broke and increase their funding cost, they will go broke. If the markets settle down, it makes it easier for them. Ultimately, we are very bearish on the end game. I mean, the simple point about some European countries are they are insolvent. Now, it depends where the policymakers...
It's just a question of when that comes up, right?
It is. But, you know, the lesson here is some people said Japan is insolvent 20 years ago.
Right.
And they're more insolvent.
That's right.
You know. But the trouble is, here we are, waiting for Japan to blow up. We could be waiting what would for an investor be an eternity, waiting for some of these peripheral countries, or the big one, it's starting to infiltrate into the core, which we're also worried about. But that could be a 213, 214 story.
Well, what about inflation? We've got Brent crude at $100 a barrel because of the turmoil in the Middle East. We've got the food price indexes all at kind of record highs, doubling in a few months. So what's your view, or what's your take on inflation this year?
It's one of the reasons why I doubt that we're going to have a really long, sustained macro expansion globally. We're going to run into constraints on commodities, and the key one for me is actually energy. Whether you think we're running out of the stuff or not, the fact is the supply pipeline is constricted on a 4 or 5 year view. We've had oil back courtesy of the growth in the emerging world with lacklustre Western world growth. If we're now talking about US growth this year at 4 or 5%, and they are, after all, still the world's biggest energy consumer, we can easily see oil at $150 again in the second half. Yes, that leads to headline inflation picking up, but I think markets would be much more likely to say, yes, it'll pick up inflation, but what it will also do is act like a tax for the energy-consuming countries, and ultimately we'll look through this short-term inflation and worry about what it means for growth in 2012.
So one more leg up in the market, you reckon? How much?
I think it could be 10-15%. I mean, that would be about right for a market that's saying this is back to normal. Now, medium term, we're not back to normal, but this is a short-term marketplace. And as we saw last year, in global equities, we had 5 moves of at least 10% last year. Each one of them happened very fast, at an annualised pace of 80%. So you could have looked through last year and said you had okay equity returns. But within that, you were a rooster one month, a feather duster the next. And I think this year we could have a great first third, perhaps half of the year. That'll be when everybody lifts their forecast for the end of the year. And as soon as they start